Jimmy says, rolling a naked put, would you ever suggest rolling down to a lower strike price? Yes. And the Power Options tools will show you that, Jimmy, if you're tracking it in the portfolio. Oh, good one. Okay, I'm going to input a naked put position, Jimmy, into my portfolio for today's expiration. I'm going to say I opened it a week ago. We're just going to leave it here in September 20th one. But I'm going to enter a naked put, short put position, and I'm going to choose NRG. Something I'm in as a Mary put. And NRG climbed back up recently up to $40, $41 or so, and I think it dropped back another $1.50 today, ended below 39 if I'm not mistaken, 38.44. So let's say 2 weeks ago, 10 days ago, Jimmy, when NRG went up above 41-ish, I decided to go ahead and sell the 39 strike put, and this would have been done, let's call it 7 days ago. So an 11-1 for just last week. Last Friday, I would have sold it for here. One contract, let's keep the math simple. And let's say we did get 30 cents. Oops, 30 cents. I'm sorry, Jimmy. Zero commissions. And it doesn't matter, but we'll say stock at the time of trade was 41.20. Okay? All right. So here's NRG. I sold the 39 put. Today it was dropping quickly, and it dropped. It was at it dropped another 60 cents later, but it was at 39 close to the open, right near where I would have had to buy it. Dropped $1. It closed at 40 yesterday. I was still looking good for today's expiration, Jimmy. And now today the stock started to fall. There's our naked put, entered into the portfolio. Sold it for, of course, 30 cents. Got that 39 strike, would have ended in the money today. I'm at a loss about 1%. That's not too bad. That's a manageable one. But anyway, here we are. November 39 put. Going to cost me 70 cents to buy it back. There's still, market maker during the day still wanted some time premium back for it. But the stock's at 38.44. When did I sell this put? I would have sold this 39 put, as I mentioned, on around November 1st when the stock was close to $41. So I was 2 points out of the money for a 7-day trade. Now, I'm seeing some rollout opportunities here. I could go to the 38 and get a positive premium, okay, out to November 22nd, 14 days away. I could go out to December down to 37.50 and get 55 cents. Remember, so I'm losing 40 cents. We took in 30. I'm buying it back for 70. That's my loss there of 40 cents. I get another, I get 55 cents. So my new adjusted net credit is 15 cents. So I might get a 0.4% as long as the stock stays above 37.50. But this is out to December 6th. I'm increasing it. I have to roll out 3 to 4 weeks, 4 weeks out in time, 28 days from now, in order to get back to a reasonable return. I'm not really close to a reasonable return. I want to be here. But that's at rolling to an in-the-money put. Do I want to go out further? Do I want to go out to December standard expiration? The 20th, for example, get 60 cents here for a 0.5% return. Better than taking a 1% loss. But how much time am I increasing it? 42 days. Okay? So here's the dilemma you're facing. In this case, you say, oh, well, the loss is small. You're only taking a 40-cent loss because I took in 30 originally. It's going to cost me 70 cents to buy it back. There's my 40 cents, which was, a small, manageable loss of only about 1.1% of the margin requirement. I can roll down and just a couple weeks out in time and turn this loss of 1.1% into maybe a gain of 0.4% or 0.1%. But we're looking at the 38 puts on this particular stock. And now we also have to pause. The stock's at 38.44. We're looking at 38, so we only have 44 cents of OTM range. Only 44 cents out of the money. And the stock just dropped $1.60 today. Here's the problem. Why did the stock drop to get you into trouble? Was it market related? And you still think you're in a strong stock moving forward and that it's sort of a leader in its industry, for example, and you think that it's an overreaction to something? and it's not necessarily market related or market weakness, it's an overreaction and you think your stock is still strong, then yes, you may roll down. If whatever happens with this is a force on the sector, the industry, or the stock itself, this fell because of bad news came out not related to earnings, it had its run, profit taking is going on, but also bad news started to come out about NRG, of course, naturally. Let's say natural gas sales are projected to fall. Natural gas prices are projected to fall in the next 2 quarters or the next 3 quarters, something that could bring the stock down. Don't roll your bullish position for a management to another bullish position if your expectation is the stock's going to continue down. Maybe close this and do something like a bear call spread to manage the loss you took. That's following the new sentiment of the stock. Before you roll Jimmy, before you roll Jimmy, one direction or the other, what happened to the reason? What happened behind the reason why you have to roll? Reanalyze your stock as if you're entering the position from the beginning. Would you sell only a 44-cent out of the money put 14 days, 21 days out in time on your normal trading plan, where your probability is only 48 or 57%? Probably not. So you probably shouldn't do it as a management technique. Yes, it could repair it. Yes, you could take a 1.1% loss to a 0.4% loss. But guess what? If the stock continues down, this next one might become a 4% loss. You're much better off taking this loss and moving on, or repairing it with the opposite as it continued down. Other ideas and concepts of this. Number 1, yes, you can roll down, but it has to match your sentiment. Don't roll for the sake of rolling. Don't put yourself in a worse position if the new, let me go to the simulate page there. We'll go to this one here for the 11/29, 21 days out. So on this tool as well, the position analysis tool in the portfolio, not only does it show you your rollouts mathematically, you can see them side by side graphically as well. Let me refresh that page so I can draw it. There we go. My original position on the left, it's at that 1% loss. My new potential position on the right, but it is 28 days out in time. But what I was saying is don't roll for the sake of rolling if you think the stocks can continue down. Why take this risk? Why not just get out of the way, close the position and move on, or maybe close the position and do the opposite if your sentiment has changed. Okay? Don't roll out 3 to 4 months in time. That's not going to match your trading plan, right? You set up a trading plan where using naked puts, I want to assume that every 2, 3 to 4 weeks, okay, let's say 3 to 4 weeks, that we're going to get a naked yield of 0.8 to maybe 1.4%, and I want to have a good 70 to 75% success rate. If this resulted, let's say it dropped further, and today I was stuck at about a $2 loss, so I'm taking a loss of 170, the only way to get a 170 premium at the strikes I'd want, 36 or 35, might be to go out to January, March, April if it's available. Well, now that's not part of my trading plan, is it? I might just have to chalk this up to the one of the trades that's going to result in my 30 to 25% of the time I'm taking losses in my naked put portion of my portfolio, but trying to limit those losses to only 1.5%, 2% or more, and put my profits at 0.8 to 1.4%, 1.5% in that range. I will still be successful long term, better than having this loss go to 4%, 5%, or having to roll out 3 to 4 months in time, hoping to turn a loser to a winner, when now I've actually kind of realized the loss anyway. It won't be realized gain until later on. Okay? Rolling down and out is something you can do if the sentiment matches. Don't roll for the sake of rolling for the risk of getting yourself into trouble. And remember, the golden rule of naked puts, and I'm sure you're, of course, aware of this, Jimmy, but the rule is never sell a naked put position on a stock you would not want to own long term. In this case, with NRG, my loss that I'm looking at on this one, if the stock now fell, remember I'm holding that 39 strike and it'd be, it's at 38.44. It had a big drop today. I might be okay taking assignment on this position, having the stock put to me at $39, keeping the 30 cents, so my cost basis is $38.70 on a stock trading at $38.44. Maybe I convert it to a covered call on Monday. If and only if My sentiment was that the reason that this happened, the stock fell to why I'm being assigned or taking a loss on the naked put, was something outside beyond the stock and something I felt was maybe market related or market overreaction, and I still think this stock's going to recover in the next 10, 15, 25 days. Don't roll for the sake of rolling if your sentiment has changed on the stock. All right, in addition to that, Jimmy, if you have time this weekend, you can go to our free webinars page. This is a public page, of course, and most of the webinars are available to the public, but some of them you may need to have an active trial or subscription to access. But under our options strategy section, as I mentioned, we've got a lot of recent webinars here, bull put credit spreads, some of the recent discussions, but rolling up a covered call, similar discussion but a little bit different. 8 ways to manage a bull put credit spread. I think I'm going to go back to 2017. Oh, it's further than I thought. My apologies. There it is. It's actually 2015. Managing your naked put positions. So you can watch this video. We discuss 5 to 7 ways one might consider managing a naked put, pros and cons of each. Yes, I realize it's approximately 4 years old, a little bit more than that, almost 5 years old, but it's 90% of the same exact content I would present to you today if I was doing a webinar next week on managing naked put positions. The trigger points, the adjustment techniques, what to look for, what potentially not to do, which we just sort of touched upon a little bit, all would be very similar to this conversation here. It's just old examples, and I'll get some, we'll get some updated ones there as well for you too. Okay, so take a look at that. Those are my thoughts on rolling down a naked put. Similar thoughts I have on the bull put credit spread. If you're in a bull put credit spread and it starts to get threatened, you've all seen this in that 8 ways to manage your bull put spread, and you're looking to roll it, sometimes it's not a great idea just to close this spread and then go out 2 months to strikes that are lower. Because if the stock continues down, now you're facing them do the same, and you're just rolling out and taking losses each time you roll out. You're not really making the full net credit back that you're going to take on the loss there. Maybe it's better to do something else. Close and do the opposite, convert it to a different spread, perhaps. That might be a key there as well, Jimmy.